for sharp, focused market intelligence. It's Monday, August 18th, 2025. And let's be honest, kicking off a trading week, well, sometimes it feels like you need less coffee and more of a miracle, right? But starting armed with the right insights, that might just be the next best thing. Today, we're digging deep into the intelligence brief for yesterday, Sunday, August 17th. Our mission, like always, is to sift through all that data, pull out the really crucial nuggets, connect those dots you might not see, and get you properly informed, fast. And this deep dive is powered by NextSight. They're a global intelligence and investigations company. They don't just, crunch the number. They really light up the whole picture behind them. Their open source OSINT platform, Site Connect, it's genuinely revolutionary. It powers these insights you're hearing right now. And it lets clients tailor reports exactly to what they need, their strategic priorities. From figuring out market shifts way ahead of time to complex global investigations, NextSight, they just operate on another level. You can check out what they do and learn more about how they turn data into actual usable intelligence at www.next-site.com. Okay, so let's unpack this. The U.S. markets last week kind of presented a fascinating puzzle. On the surface, consolidating near record highs. But you dig just a tiny bit deeper and, well, you find some really potent undercurrents. They tell a much richer, maybe more cautious story. What was the core tension you saw playing out?
Well, what's truly fascinating here is exactly that tension, that subtle push and pull. Take the S&P 500. It closed Friday at 6,449.80 U. Okay, a small slip, 0.3% on the day. But look at the whole week, still up a respectable 1.2%. Shows some surprising resilience, doesn't it?
Yeah, it does.
And the Dow Jones, it eked out a modest gain too, up to 44,946.1 downs. NASDAQ was basically flat. So this isn't just a market pausing for breath. It's the market's collective poker face, holding its breath. Because on one hand, you've got earnings season still going strong, about 90% of companies beating estimates. That fuels, around 11% earnings growth? That definitely buoys sentiment, but, well, that's only half the story, isn't it?
Right, exactly. So strong earnings gave that foundational lift, but then you had these equally strong things pulling the other way. We saw that producer price data come in hotter than expected, and then those, pretty hawkish comments from several FOMC officials. That's the Fed's policy-making body for anyone new tuning in. How did those two things kind of interact? How did they shape expectations?
Precisely. That combination, it really tempered the rate cut hopes that had been gaining some serious steam. And if you connect this to the bigger economic picture, it gives you a crucial reason why the U.S. yield curves are still so steeply inverted. As of Friday, the 10-year Treasury yield rose to 4.33%. That's up 4 basis points just from Thursday. Meanwhile, the 2-year finished at 3.75%. So that leaves us, a 58 basis point spread between the 10-year and the 2-year?
58 points.
Yeah. Now, for you listening, an inverted curve usually signals market expectations of slower growth, maybe Fed cuts coming. It's that classic recession warning sign. But this particular spread, hovering around 58 basis points, that really deepens the warning. It shows a really strong market conviction that the Fed will have to cut and cut aggressively, even if the chatter from the FOMC right now doesn't quite line up with that yet. It's a big bet the market's making, a high-stakes one.
That definitely deepens the plot. So while the U.S. markets were doing this sort of delicate dance, if you look globally, it's a very different story. We saw some pretty stark divergence playing out last week. Not every market just followed the U.S. sideways trend. It's just some powerful regional forces at work.
Indeed. European equities, for example, they actually delivered their third straight week of gains. The StopXX Europe 600 closed at 553.87, up a solid 0.55%. And that was driven mostly by rallies in home builders and defense stocks.
Interesting combo.
It is. And the FTSE 100 in the UK, even though it slipped a bit on Friday, 0.4%, it still finished the month up, 2.4%? Pretty impressive. And what's really insightful about the UK homebuilder performance, it ties right back to the U.S. market. Remember Berkshire Hathaway's recent move, buying D.R. Horton, increasing their stake in Lennar?
Yeah.
Investors are clearly reading that as a major vote of confidence, not just in U.S. housing, but maybe as a broader signal for residential construction globally, especially if you expect rate cuts to give things a tailwind.
Okay, so Europe found some clear momentum, partly reading off big U.S. investor moves. Let's shift over to Asia. Japan's Nikkei 225 surged. What was it, 1.7% on Friday? That's remarkable. What was driving that optimism, especially that rotation into tech names?
Japan had a really strong finish to the week. That rotation into tech was definitely part of it. But it also got a big boost from a weaker yen that helps exporters, and there's growing speculation the Bank of Japan might hold off on any more policy tightening for now.
Was more room to run.
Exactly. More runway for growth. But in stark contrast, you look at China's Hang Seng, tumbled nearly 1%. And that was mostly down to those persistent property sector problems and just chronically weak credit growth in the country. It's a really clear reminder of the hugely different, sometimes conflicting economic pressures playing out across the globe right now.
Which brings us to a really crucial question. What does all this divergence, this U.S. holding pattern,
Yeah.
what does it mean for overall market sentiment? And specifically, volatility. Seems like we're seeing some interesting patterns there too. Hints of calm, maybe. But is it? Is it the calm before a storm or something more genuine?
That's an excellent question, and one I think we really need to consider carefully. We've seen this remarkable collapse in cross-asset implied volatility. The VIX, that's the S&P 500 vol measure, it's just languishing around 14.8.
It's pretty low.
Super low. The MVE index, Treasury vol at near 76. Even Bitcoin's 30-day implied vol is down around 36%. All these numbers are near multi-year lows. And broadly, yeah, it reflects a market that's pricing in an almost certain U.S. rate cut in September. But, and this is the important bit for you, our listener does this signal complacency. Because given how sticky inflation still is, plus you've got potential for higher tariffs, ongoing geopolitical risks, there's a very real risk market expectations could get sharply repriced if things don't play out exactly as planned. That calm surface could be hiding some pretty choppy waters underneath.
That makes perfect sense. Yeah, a calm surface. But with those currents, feels less like tranquility, more like everyone's holding their breath together.
Okay, shifting to currencies. The U.S. dollar index, the DXY, it slipped again, another 0.4% to 97.86. That extends what's now a 0.5% decline for the month. What's driving the dollar's softer trend here?
Well, the dollar kept softening, mostly as investors started pricing in a European economic recovery that boosted the euro to $1.1701. At the same time, for the UK, the pound strengthened up to 1.3545 says the market's anticipating upcoming Bank of England rate cuts there. Meanwhile, the yen actually showed some resilience. It firmed up below 1.47 per U.S. dollar. That happened particularly after reports noted the 10-year Japanese government bond yield just edged up slightly to 1.56%.
Just a little tick up. Just a little tick, but it hints at potential shifts in the Bank of Japan's super loose policy. Makes the yen a bit more attractive.
Gotcha. And what about the crypto space? Has it been marching to the same low volatility beat, or is it doing its own thing?
Bitcoin,
Right.
maybe surprisingly, has been hovering pretty quietly near $118,000. And its implied volatility is also right around those two-year lows we mentioned. Seems like traders are really just waiting for Fed Chair Powell's speech at Jackson Hole. That's certainly keeping a lid on any big moves.
All eyes on Powell.
Pretty much. On the stablecoin side, Tether, a major issuer, put out a strong report, $162.6 billion in assets, a hefty $5.46 billion surplus. That really reinforces its role as a huge liquidity provider in the digital asset world. Kind of provides a stable anchor. Oh, and just for completeness, worth a quick mention, Duquan recently pled guilty to charges related to the Terra collapse. That's a significant step in the ongoing effort to bring some accountability, maybe some regulatory clarity to the crypto world.
Right. Okay, let's pivot now to those foundational sectors. Energy, commodities, real estate. What did the past week reveal there? What are the key takeaways for our listeners tracking these bedrock industries?
Energy markets were generally a bit softer. WTI crude fell down to $63.14 a barrel. Brent slipped to $66.16. This dip came after U.S. inventory data surprised everyone with a build 3.037 million barrels in crude stockpiles.
Oh, build. In summer.
Yeah, a surprise build. And while gasoline inventories did fall, distillate stocks actually went up. That suggests these lingering demand concerns are still weighing on prices, even during peak driving season.
Though it sounds like natural gas had a slightly different story, up 2.8% to $2.92 per MMBtu. That's million British thermal units, the standard measure there. Was that just a temporary blip?
It was a rise, yeah, mostly driven by short-term heat forecasts boosting demand. However, and here's the context, if you connect this to the bigger supply picture, natural gas prices are still down 17.7% over the month, and storage levels still a significant 196 BCF above the 5-year average.
Oh, okay. So still lots of supply.
Yeah, exactly. That clearly signals an underlying oversupply that's probably going to cap any sustained price surge unless we get a major long heat wave or some kind of disruption. Meanwhile, gold held steady near $3,335 an ounce. Copper near $4.47 a pound, both holding their ground. Investors are clearly still using them as hedges against that policy uncertainty and geopolitical stuff.
Okay. And on real estate, you mentioned distinctly mixed signals earlier. Can you break down that more nuanced picture for us? What's happening with mortgages, home builders, commercial?
Yeah, it's definitely a mixed bag. On the plus side, 30-year mortgage rates eased off just slightly, down to 6.58%, offers a little relief for home buyers anyway. And we saw home builders rally. That was clearly on expectations of fresh rate cuts coming, reinforced by that Berkshire Hathaway stake in D.R. Horton and Lennar we talk about.
Right, the confidence vote.
Yeah, it suggests maybe a tentative recovery, some renewed confidence in the residential sector. However, REIT performance, it diverged pretty sharply. Equity REITs gained 0.52%, reflecting that residential optimism, but mortgage REITs actually fell 0.40%. They're still feeling the pressure from higher funding costs and that higher for longer rate environment impacting their loan books. And commercial real estate, especially offices, still grappling with big challenges like high vacancy rates, although it is getting some benefit from strong industrial and logistics demand, driven by all the e-commerce growth.
Okay, so zooming out from all these specific points and market moves, what are the big overarching trends and risks shaping the market right now? The things our listeners absolutely need to keep front of mind. What's the bigger story playing out?
Well, arguably the most significant trend is this monetary policy inflection point we're at. Markets are, frankly, quite aggressively pricing in a 25 basis point Fed rate cut in September. But we have to remember, inflation, while it's eased some, is still kind of sticky. And some FOMC members are still sounding surprisingly hawkish.
That tension again.
Exactly. That underlying tension between what the market expects and what the Fed is saying, it could very well delay any easing. And this leads straight to Jackson Hole, which is just days away now, this annual central bank meeting. It has the potential to either kick off a broad risk rally, if Powell sounds really dovish, or conversely, it could spark significant volatility if he keeps a more hawkish line. Big moment.
And that ties right back to what we were saying earlier about volatility complacency. With the VIX and MOVE indices so low near multi-year lows, it really does suggest the market might be a bit too comfortable, maybe a bit naive about potential surprises.
Precisely. That market complacency, it signals a significant vulnerability to unexpected news. And this also connects to what we're seeing in credit tightness. Corporate bond spreads, both high yield and investment grade, are near cyclical tights. Now, for our listeners, what that means is the extra yield investors demand to hold these bonds, basically the compensation for risk, it's incredibly low. High yield OAS, that's option adjusted spread, is at 2.89%. Investment grade OAS is just 0.77%.
Really tight.
Very tight historically. Leaves almost no cushion if growth disappoints or if we hit an economic downturn. It's a classic sign of, well, significant market optimism, maybe bordering on overconfidence. And you also have to keep in mind ongoing energy supply risks. Despite those recent inventory builds and the persistent issues in China property sector, broader growth concerns, those continue to weigh on Asian markets and global sentiment.
Okay, this raises a really important question for our listeners, always looking ahead. Knowing all this, what specifically should they be watching out for this coming week? What's on the catalyst calendar that could really move the needle?
Well, the coming week is definitely packed, leading right up to that crucial Jackson Hole event. On August 20th, Tuesday, we get the FOMC meeting minutes. That'll give us some crucial sort of behind-the-scenes look at the policymakers' discussions, what they're really debating about inflation, jobs, the timing of cuts. Same day, the EIA weekly petroleum status report. Fresh inventory data, vital for energy prices. Then, August 21st, Wednesday, the EIA natural gas storage report. That gives us an update on the supply-demand balance with the current heat forecasts. Could influence prices there. But the real main event, the big market mover for the week, is undoubtedly August 22nd, Thursday. Fed Chair Powell speaks at Jackson Hole. His keynote speech. Every single market participant will be dissecting every word. It's going to set expectations for the September FOMC meeting and broader policy. His tone dovish, hinting at cuts, or hawkish, pushing back that will directly hit all asset classes.
Huge implications.
Huge. And finally, the broader central bank symposium at Jackson Hole on the 22nd and 23rd could also offer hints about coordinated global central bank actions, which would have major implications for currencies and rates worldwide. It's going to be a fascinating and potentially quite volatile few days.
Okay, so for those looking to actually translate these insights into strategies, what are some key operational considerations? What does Operations Watch suggest for navigating this pretty complex environment?
Yeah, the Operations Watch section has some really concrete ideas to think about. First, with implied volatility near those historic lows across different assets, it's a compelling time to think about putting on some short bull hedges. What that means is looking at long volatility positions, or maybe tail hedging, effectively buying insurance when it seems cheap for protection around Jackson Hole and other data releases coming up. Low option premiums can offer a really attractive entry point for that kind of defensive move.
Buying protection when it's on sale, basically.
Kind of, yeah. Second, in fixed income, think about duration management. Maintaining a barbell position that's a mix of short and long duration bonds and maybe gradually extending duration can help capture yield if long-term rates drift higher. Critically, this keeps you flexible. You can add exposure on dips without going all in. But remember, avoid too much leverage. That inverted curve is still flashing a warning sign about recession risk. Third, think about equity rotation. Maybe favor cyclical sectors, industrials, materials, home builders. Those tend to benefit most from falling rates and a better economic outlook. But be selective in tech. Valuations are still pretty rich, and you've got those ongoing geopolitical risks that could mess with supply chains. Over in Europe, defense and infrastructure spending, those specific sectors might continue to outperform.
Okay, good points. What else?
Fourth, FX hedging, potential US dollar weakness. It could stick around if the Fed signals aggressive cuts, or if other central banks sound more hawkish. So hedging your USD exposure, maybe through allocations to the euro or the pound, or even using currency overlays, that could add diversification and cut down overall portfolio risk. And keep a very close eye on the USD-JPY pair. Any surprises from the Bank of Japan could shift that currency pair dramatically. And finally, for commodities, probably best to maintain balanced exposure. Considering long positions in gold as a hedge against policy mistakes or just general market jitters seems proven. Maybe use any big dips in energy prices to build positions ahead of the winter heating season, but stay nimble with natural gas given those oversupply risks we talked about.
That wraps up our deep dive into the Sunday, August 17th, 2025 intelligence brief delivered to you on this Monday, August 18th edition of the Deep Dive. And just a quick reminder, if intelligence that actually adapts to what you need matters, Next Site delivers. They support executives, analysts, investigators all over the world with insights that aren't just reliable, they're immediately actionable. Find them at www.next-site.com. Don't forget to subscribe wherever you listen, YouTube, Spotify, wherever you get your insights, and share your thoughts. Leave us a like, a comment, or share this deep dive with someone who could use it.
Yeah, and as you head into this week, maybe chew on this. The market seems almost weirdly calm, doesn't it? Despite huge catalysts like Jackson Hole staring us right in the face, how much of that calm is real conviction and how much is just, well, complacency maybe setting the stage for a really surprising week? Understanding that underlying tension between what the market thinks will happen and what the data or policymakers might actually deliver, that's going to be absolutely key to navigating what could be a very dynamic few days ahead.
Exactly. Let's make this week smarter, sharper, and maybe, just maybe, a little less Monday.